Okay, the question came up about, the question was actually how you personally factor in the short volume percent on what you're thinking as a direction on the stock. So that's a very good point that Darren brings up. This is a simple place to go to is shortsqueeze.com, shortsqueeze.com. The official site for the NASDAQ is where you can go to find the short index or the short position. This has changed a bit, so I'm not sure. I'm not going to bother looking for it right at the moment. But if you want to get the actual short positions on NASDAQ stocks, the best place to go is to the NASDAQ site itself. Now you have to remember that the NASDAQ only reports twice a month, first of the month and the middle of the month. So any number that you're looking at, unless it's the first of the month or the 15th of the month, may not be quite accurate. Now but they don't change that much necessarily. Like for instance, this is AXSM. It shows that it has 4 days to cover, and I'm going to get into that in a second. And this 12% of the float is short. It's increased 4%, was 3.4, now 3.5 million. So this was first announced, this would have been the June 15th number. This number 3.5 is the July 1st number. So we've gone another 10 days, so that'll probably change again. What is the calculation first? Well, the short interest rate obviously is the number of shares reported short as the percentage, of course, as a percentage of the total float. So you can see just by a calculation, this is 12% of 28,770. That takes you to 33.4 million. Days to cover is a theoretical number. Days to cover is a theoretical number in that you take the volume, the average daily volume, in this case, 820,000, and you divide that by the short interest, and it would take 4 days. If only shorts were buying the stock and they wanted to cover their total position, it would take them 4 days to cover their position. So it's just a theoretical number. It doesn't really mean anything in the sense that it's not, there's no way that just the shorts are going to be buying and they're all going to buy at the same time, and 4 days later they're all going to have covered. That's not it. But what it is in a sense is an index. And it's my theory that if there's 5, okay, so let's go back one step first. The important thing about the days to cover is that, now let's talk about the short position first. The important thing about the short position is the larger the short position, if you're looking at a stock, let's have a look at CCL. This is the Caribbean Cruise Line, and we'll look at their short position in a second. This is an ugly chart, and when it was down in here, this level, it had a huge short position on it. But as it was falling, the short position was increasing. The larger the number of shares short, the more bearish the market is on the stock. And rightfully so, in this case. Boom, 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 double bottomed in here. But the larger the short position, the more negative the market is, and that is a negative. The bigger the short position, the more negative position it is of the stock, and likely it's going to continue to drop, to trade lower with a big short position. The caveat to that, of course, let's see what this short position is on CCL. So 26% of the stock, 26% of the stock is short, 122 million short. And why are they short? Well, because the cruise industries, nobody's going to be riding cruises. They've got them closed or canceled, all those kind of things. And so this is very, very bearish. But we can see this says 1.7 days to cover. I find that a bit hard to believe. Let's have a look and see how much this. Well, let's see. It trades 62 million a day. So it's very liquid. So you can have a big short position, and it's not. But I'm going to talk about that next. So my point being is that the bigger the short position, so like Carnival, the more bearish they are in the stock, and more likely it's going to go down. Because every time it pops, they just short more into it because the news is so bad. What is of interest to us as traders in the short position, if I can find it, is this number here, days to cover. I have a theory. It's a famous Monty Python line. My theory. I'd have a theory on this, and my theory is that when there's a short interest of 5 days or less to cover, where the short position becomes significant for us is when there's a catalyst, earnings, corporate news, discovery, takeover, whatever the case may be. If it's 5 or less, then the short position, 5 days or less to cover, then the short position is not going to have that much of an effect on the direction of the stock. It's going to help, but it's not going to be a big deal because this can trade in 2 days. It's going to cover all the shorts. So this is very liquid. People can trade it, so it's not a big deal. If you have a short position between, so we got what was the one I was just looking at? I was thinking, oh yeah, NEO maybe. NEO is the same thing, but this is a bit different because, it only has. It doesn't say what the short position is to the float. It's 130. Now that's a lot of stock. I think there's a billion shares outstanding or something like that. Market cap. If it's at 10, that'd be 11. Yeah, so it's like a billion or 800 million or something like that. It's very liquid, but that's a huge short position. So this may be not a good one to look at. New GBX. This is a bit different. Here's you go. So this GBX, 12% of the float, 6.6 days to cover. So it's my theory that less than 5 days to cover and a net catalyst, it's not going to do much for you. Between 5 and 10 days to cover, and you have a catalyst, which we did with the GBX. Then it's going to affect the price. There's going to be an effect on the price of the stock. There's going to be some impetus and some upward momentum for it, and some built-in buying, which we got. We can see that this popped initially as shorts covered, came back, and then when it opened, the shorts, they got to start covering, and they did. And so between 6 and 10, you do get an influence to the upside. Where you really start to see the fireworks, and I don't have an example of, and I can't think of anything off the top of my head right at the moment, but we do have them in the past, is when you have a catalyst, you have over 10 days to cover, and you have a catalyst, then the fireworks begin. And we've seen them go. Stocks run $10, $20, $30 as shorts get squeezed. And what happens is the existing shorts get squeezed, but short sell it. Because if you have a big short position, people are very negative on it. So any kind of pop, they're going to short into it. And so what happens is you get the shorts selling to the shorts, but they just get this huge squeeze. So anything over 10 days or more to cover, here, if we could find a stock, if I put one in and it was 10 or greater, and you get a catalyst, that's your big short squeeze. So